everyone. Thank you all for taking out time today. Now we can begin our webinar. So today we are going to talk about on the corporate tax and transfer pricing for distribution and logistic businesses in UAE. So this field of tax and audit field for last 21 years, worked with Big Four Consulting, Deloitte, PwC, has been providing on the corporate tax services for clients. And as a site beyond consulting, we are based in Dubai. We provide corporate tax transfer pricing services, VAT services for clients, and also on the technology side of it, we support our clients on different automation businesses around. So, and with me, I have Prajakta and Prakati. So, Prajakta carries a similar around 10 years experience in the international taxation, corporate tax, while she was working in India with PwC and been associated here in with the side beyond consulting for the international taxation and corporate tax side of it. And Prakati similarly carries her experience from Deloitte, where she worked with on the transfer pricing and international taxation over 12 years on the international taxation, and she has been also working on different projects in UAE. So today, what we are going to talk about is limiting ourselves from the different ministerial decision decrees which has been coming across, and we have compiled that information and put up different case studies which has been published by the ministries to elaborate our explanation on the distribution and logistic business. So it's our personal opinion on some of the case studies or interpretation which we are taking. It's a personal opinion, maybe something which is specific to your businesses, which might require a detailed discussion and a consultancy to understand, because each business might have some specific transactions which would be applicable to your case and that need a detailed interpretation and understanding of the cases. So I invite Prajakta. So I mean, what we are going to cover is, before I invite Prajakta, just to talk about the topics which we are going to cover. Of course, basics about the corporate tax, the registrations. Then we will get into the detail of the topic which we will be covering on the distribution and logistic business, and then how they meet those criteria to be fulfilled as a qualifying free zone, and what are the substance requirement to be done. And then we would be taking about the transfer pricing, documentation requirement from the connected and related party transactions, how those has to be determined, what's arm's length determination, and some aspect of the city administration. So as we are progressing through this webinar, you may put up your questions on the chat box, and then at the end of the session, we will take through those questions. So whatever that comes up during our discussions, just keep on posting those questions in the chat box, and we will discuss about it. So now I invite Prajakta to take over to talk about on the brief about the corporate tax in UAE and the registrations.
Thank you, Manish, for introducing me, and thank you joining us over here in the webinar. So as everybody might be aware that the corporate tax is now effective in UAE since June 2023. And depending like on their financial years, the companies are following, like it can be from July to June, or October to September, Jan to December, or April to March. You need to file your corporate tax return in the next financial year. Generally, in the UAE, the companies follows Jan to December financial year, for which you need to file your corporate tax returns by 30th of September 2025 next year. So this is going to be the first year for the corporate entities to file these returns in the UAE. Now, in terms of the tax rate or the taxable income, so basically the corporate tax is going to be levied on the taxable income, not on the turnover. So if you're earning, your general tax rate for the corporate tax is 9%, where you have this slab rate of 375,000 dirhams, where up to 375,000 dirham, you don't have to pay anything. It's just a 0% tax rate. And if you're earning more than the 375,000 dirham, then the 9% is a tax rate applicable for you. For example, if your taxable income is 500,000, then you have to deduct 375,000 first, and the remaining 125,000 will be the income on which you'll be paying the 9% tax on that. And in terms of the qualifying free zone person, what is the qualifying free zone person and how you have to determine that you fall into qualifying free zone person, that's something Manish will take you through in the subsequent slides. But if you fall into qualifying free zone person, in that case, the qualifying income subject to meeting certain conditions, then the tax rate will be 0%. There will not be any tax on that. However, there are certain conditions where if you are earning, you are not fulfilling those criteria, you will be earning the non-qualifying income, and for that, the 9% will be the tax rate straight away on that income. There is no any slab rate or any threshold limit applicable to you in that case. You'll have to straight away paying the 9% on the non-qualifying income earned by the qualifying free zone entity. Now, who is applicable, to obtain this corporate tax registration? So it's something that depending on the rules and regulation which the Federal Tax Authority, they have laid down certain conditions based on which you need to identify on which basket you will be falling into. So basically, there are two types of person who will qualify or who needs to obtain this registration. These are the resident and non-resident person. But in case of a resident person, if you will become a resident person only when you are in terms of mainland entity or a free zone person who is incorporated in UAE, then you have to obtain this corporate tax registration. If in case you are incorporated outside UAE but getting control or managed UAE, so then you have to again obtain the corporate tax registration. So how you will decide that? There are certain guidelines which have been laid down, like for example, who is the person taking the decision for those entities, or from where you are taking the entity, the decisions for those entities. It should not be like you are just rubber stamping the decisions outside the UAE and where the key persons are sitting in UAE. So in that case, you will be considered as a controlled and managed in UAE, and you need to obtain the corporate tax registration for such kind of entities. And moving to the natural person.
Mr. Ravi, can you mute yourself because your voice is being heard? Mr. Ravi, can you mute yourself? Mr. Ravi, can you mute yourself? Yeah, Project.
Yeah. So third basket is the natural person. So in case of a natural person, generally there is no corporate tax in terms of if you are earning any salary income or investment income or any kind of income from the real estate. But however, if you're doing any business activity, conducting any business activity in UAE, then you are obligated to register yourself under the corporate tax. Now, moving to the non-residents, here, if you're having any branch in UAE, then you will be called as you are having P in UAE. In that case, you need to obtain your corporate tax registration. Second point is that if you're having any kind of nexus in UAE, what do you mean by that? It's like if you're having any real estate or any property in UAE, it means that you have a nexus in UAE and you are earning income from that such kind of a nexus in UAE, then you have to obtain the corporate tax registration. And a third point is that if you're like, for example, any kind of agent who is you're doing the business in UAE, but they do not have any office or any setup in UAE, but they are earning the income from such kind of transactions which they are doing in UAE, then in that case, it will be termed as that you are deriving the UAE sourced income. And in such kind of scenarios, there is a withholding tax applicable. But however, currently in UAE, there is no withholding tax. So you need to analyze on this basis, like in which category or which type of scenario you are falling into, and accordingly, you need to obtain this registration. Just to be mindful, this corporate tax registration is not is restricted or attached to any particular limit except the natural person, because they have a limit of turnover 1 million dirham. Other than that, if you are falling into these conditions, fulfilling these conditions, you need to obtain this registration. And in case, and all these registrations are also attached to your trade license. If you have any trade license and EOE, you need to see your issue month, and accordingly, there are certain deadlines given by the FTA, and you need to fulfill those criterias and obtain this corporate tax registrations. Yeah. So Manish, over to you.
Yeah, thank you. Thank you, Prajakta. Just to add on to this, like, since this registration is based on the threshold, or there's no threshold actually, except for natural person. So if you think that you might not be earning income, this is a year one, the first year you started your business and you are not making any income, you don't have to register. No, that's a myth. You have to register whether you make profit or not, irrespective, and whatever turnover you make. If you are a LLC company and if you are on free zone company, wherever, if you are carrying out a business, so registration is mandatory. So don't get into that, because in VAT we have that threshold of 375,000 as a mandatory, or a voluntary, or 187,500 as a threshold for revenue where VAT registration. But in case of corporate tax, there is no threshold. If you are making a business, so you have to register whether you make profit or not, whether you are going to make a taxable income or pay tax, irrespective, registration is mandatory. So now getting into the qualifying activities, which Prajakta was mentioning about, that there is 0% slab and a 9% that they would get a benefit of 0% corporate tax rate. So now, what are those activities? I mean, before you get into of analyzing whether the setup is in free zone or designated free zone, but you need to understand that what are those activities which would be getting those benefit of 0%. So to look at those activities, so there are, like, pertaining to the goods, there are 4 such category of goods pertaining, which are like for manufacturing of goods or materials. These are like, if you have a manufacturing facility in either of the free zone area, because these are something which you need to think. If today you are carrying out these activities in a mainland of Dubai, Sharjah, and you see that majority of your income is coming from the manufacturing or any of those activities, then you might look around that how do you get benefit of the free zone, or whether you need to move out of your mainland, any of those areas, to a free zone area based on the volume of the business you're making in and the benefit you derive. So any manufacturing activities, production improvement or assembling of that in any free zone, you get a benefit. But substance and all those we will look at in the subsequent slide. Similarly, any processing, which includes, processing include packaging, repackaging, any kind of branding to that is also a part of the processing of the material. So someone is receiving it and packaging it, that also becomes a part of the processing. Then distribution is a major activity which we can see in UAE, whether it could be a third port shipment or from UAE to any other country. But there's one criteria, that it has to be a designated free zone area from where you are carrying out this. So that's the today's topic, which we will discuss in detail. Then about the trading of the qualifying commodities, I know that is these are the commodities which are traded on the stock exchange, there, and which are recognized stock exchange. If you are into those activities, then that become a qualifying activity, as that is already regulated and they get that benefit of 0% in the case. Now looking at there are services as well beside the goods. So the services includes holding of shares, security, investment. If a company is just investing in other companies, but there is a holding period of 12 months on those investment which the company is making in, then this is a qualifying activity. Ownership, management of ships, that's something is also there. Then reinsurance services, these are all are regulated, so they get the benefit of qualifying. Fund management services, or a wealth or investment management, that someone is doing this activity to manage the funds on behalf of others, make an investment decision on their behalf of others. That is also like a services being performed. It's a qualifying activity. Then headquarter related, I think that's most common. We can see where there are a group of companies and where they are providing headquarter services in terms of HR, accounts, or central procurement, those or some kind of management services for their group companies. Then that also benefit from your qualifying activities, provided they are in the free zone. Then even treasury financing activities to the related parties. So there is a, I mean, there is any free zone company which is providing a treasury function to financing activities for giving funds to their related party,
What I want you
but
to do
that is done by from the free zone
take out, I'll
as a
give
being
you
a centralized.
statement. Or can you take out?
Miss Sangeeta, can you mute
Yeah, please.
yourself because it is disturbing
I'm
others?
really sorry. I'm really sorry.
We
Thank you.
request all the participants to please mute themselves so that this seminar can be taken in a better way. Thank you.
Then talking about the financing and leasing of aircraft, that is also there, and the logistic services. So I'll run through you on the subsequent slide with respect to distribution and the logistic services. So these are the qualifying activities, if any of the businesses which carry out these activities, and then if those are being carried from the free zone and meeting other conditions, then they benefit from the 0%. Now, beside this, there is excluded activities. Now, if you do any kind of this which are excluded, then you don't do 0%, which it includes any transactions with a natural person. So anyone who is dealing with individuals, selling business, doing any kind of businesses with the individual as a natural person, they don't benefit, except these are exceptions. If someone is doing ownership management of ship, that means they are selling tickets or managing the ships, on boarding the crews, then those are being done to the individual, that still get benefit. Fund management person is benefiting, and financing and leasing of aircraft to a natural person, that also becomes an eligible activity. These are exception to the transaction with a natural person. And then banking activities are separately taken care, and these are excluded activities. Insurance activities are also an excluded activity, except the reinsurance or headquarters services, which we looked into it in terms of account support services, centralized support services, or centralized insurance services. Then financing and leasing activities, and except to the related parties, or with respect to the aircraft, or with respect to the operation and management of ship. So this financing and leasing is an excluded activity, so you don't benefit of 0%, but exception is given with respect to the related parties or aircraft ownership. And then ownership and exploitation of an immovable property, which is other than a commercial property. So if you have a commercial property in free zone, that is being let out for office purpose to another free zone. So a DMCC, if you have suppose a commercial property in a DMCC and is being let out to any other free zone person, that Dubai Silicon Oasis person having an office in DMCC, he's paying rent. So that is a qualifying activity. But if that is being given, that commercial property is given to a Dubai mainland person who doesn't have a license of the free zone, and he just taken an office on rent in a DMCC area, then that letting out of for rental to a mainland who is a non-free zone person will be excluded activity. So it is not part of a qualifying activity. So getting into the detail of the qualifying activities, which the distribution. So now distribution is majorly categorized. The first criteria is that it need to be, in and from the designated zone. That means there are several free zones here, and some of them are designated zones, like Zabza is a designated zone, or RAC free zone could be a designated zone. So if anything which is carried out from a designated zone to benefit from a distribution activity, you need to have a setup in the designated zone, and any ordering, processing, and everything has to be done from there, and you have a substance in the Zabza, then you can be eligible for a qualifying activity. Now, what are those distribution activity? It includes buying or reselling from a manufacturer, or reselling to a retailer. So if you are buying from a manufacturer or a reseller, maybe from Singapore and selling it to Saudi, and these also cover high sea sale, the third port shipment. That means movement from Singapore to Saudi. The order is getting processed from UAE designated zone. Even it is not touching the port of the UAE, they still get benefit of this qualifying activity. Or even this distribution also cover the storage warehouses, storing those goods, inventory management, ordering of those, maintaining the stock level, order processing, receiving orders from the customers, taking and delivering it to the customer, and even the transportation services, though logistic services is separately covered, but because of the distribution activity, you would have those elements of receiving it, storing it, and dispatching it. So even the transportation or warehousing comes under this, and sometimes it might have that you take the goods and package it and repackage it from the bulk to retail packing. You might do it and sell it off. So that is again a distribution activity. But here the main element under the distribution and logistic which we'll look around is that distribution is you get the title of those goods. When you purchase it, like you're buying it from Singapore and selling it to Saudi, then you take the ownership, you get the title of the goods, you are actually buying it and then selling it. It's not directly billing from Singapore to Saudi. So the billing is happening from UAE. You are the party sitting in UAE is become the owner of the goods, and he's billing it from here. So that's the distribution activity, and it also includes some kind of marketing, because you're going to advertise those products and sell it off and have a quality inspection from the manufacturer or reseller, or any kind of post-sale services or customer support services you might carry out. So that is also part, which is an ancillary activity to that. So as just reiterating on that, designated zone is very critical, that you need to have a place of business, office and substance is created in a designated zone. Then only this qualifying is distribution becomes a benefit of qualifying activity. And then another important is title of the goods, that you get the ownership of the goods and then you are redistributing it. The another concept is tangible. This is all our physical goods, software. If you are doing a business of software trading, then that doesn't get involved into this. But if you are providing that software in a hardware system, that along with the product, the software is included in this, then that is a tangible good, and that can be still considered as a qualifying activity. Then it is basically a reselling, that you are not buying for yourself. It's a distribution. You're buying it from Singapore, selling it to Saudi. You are not taking it for your purpose, but you are going to redistribute that. So, and this also requires that, when someone who's dealing with the distribution business and he's selling it to Saudi, then Saudi, if you're selling it to Saudi person is not keeping it himself. He's going to redistribute in the Saudi market. So that is important. And to make sure that the person is a distributor to whom you are selling it, you need to have a KYC or a contract, making sure that he is not going to consume himself. It has to be distributed to third party. Then provided such, again, designated zone is there, or if you are dealing through a sales agent. If you are dealing through a sales agent, then it doesn't qualify. There's some third party who's involved into it and is selling it, and he's become the sales agent and buying and distributing. So sales agent person who doesn't qualify, but you yourself should be selling it to a redistributor, a retailer, to qualify for this activity. We can look at some examples on this. So this is an example where a manufacturer, say Singapore, I was mentioning, is country A. The designated zone is Zavza, company C in Zavza, and then selling it to Saudi company. So the order is booked, and the invoicing is happening from designated zone to Saudi, and then payment and everything is happening to the manufacturer in Singapore, and then the sale collection is happening in the Zavza from the Saudi. So this is a qualifying activity. Then there another is basically, this example is where you are receiving the goods in UAE. So instead of sending it to Saudi, you are getting these goods from the Singapore, and the order is created. Everything is from the Zavza free zone, designated zone, and the goods is entering the UAE and through a designated zone, and then it's being distributed to distributor or retailer who is not an end consumer, and maybe it could be sent to Dubai mainland or Sharjah from the designated zone. So this also qualifies as a distribution qualifying activity, or it could be within maybe other way around. So from UAE, you are exporting it to any other country. So you're exporting to Saudi from buying it from the UAE mainland, that is Dubai or Sharjah. But that again, the company who's buying it or distributor is based in Zafza designated free zone, any other designated free zone, and then supplying it to country, which is Saudi. So this is basically also a case of qualifying activity. Then it can also happen within UAE to UAE. It need not be like you need to get the goods from outside UAE and then supply. You even can buy it from, like, you're buying it from Ras Al Khaimah free zone, Ras Al Khaimah manufacturer, and selling it to Dubai. But that the distributor is based in Zafza free zone, designated free zone, and even within the UAE as well, buying and selling within UAE, that also is a qualifying activity provided carried out from the designated free zone. So now getting into the logistics services, what are those? So if you see those definitions which are included under the qualifying activities to be a logistics services, it's basically transportation on behalf of another person. That means you are not taking the legal title of the goods. You're just facilitating the transportation on behalf of another person. So when I was mentioning about this Singapore and Saudi, so you are not getting the title. You are just facilitating a shipping arrangement for movement of goods from Singapore to Saudi, or from UAE to Saudi or any other country. Cargo handling, warehousing, because it would also involve a warehousing facility for storage for a day or two, whatever time, and also a custom brokerage services that you might be arranging a transport or a custom clearance support along with it. So that also becomes a logistic services. Order fulfillment, that means you're taking an order and processing it.
Yes, please send me the email. I will have to submit the checks then. Okay, then. Thank you so much.
Daniela, can you please mute yourself? Then inventory management, tracking maintaining the inventory level. Freight forwarders, who are basically freight forwarders, that they're taking the order, arranging it to a shipping company or any brokerage services, is a part of the logistics services, provided this is being carried from a any free zone. It need not be a designated free zone, but any free zone, like if you're doing from Dubai Silicon Oasis or DMCC, even not being a designated free zone, you can still be benefiting for this logistics services. So this is an example where a logistic company, say it's in Dubai Silicon Oasis, and then he's taking an order, supplying it from, it could be like from Singapore to Saudi. That is an outside UAE. Also, you're taking an order from Singapore and supplying it to Saudi. So that itself is there, and even from UAE to any other country. So the dispatch or the transportation happening through is a qualifying activity, and the person who's doing this logistic services is based in a free zone. So some of the examples of the logistic services, like we say a company R has requested for shipping of 5,000 units to a stores across Saudi. That is a distribution activity, which is basically logistics. Supplying to different stores, arranging the transportation either through sea or by land, so that they're charging some freight of 10 per unit of transportation. So that revenue of 50,000 for supplying this 5,000 unit is a transportation facility from UAE to Saudi. And even a warehousing facility being provided, like someone has asked, that company R has asked to store these goods for 3-month time, and then that warehousing facility being provided is part of the logistic services. Order fulfillment is basically you're taking the order on behalf of your customer and processing that, transporting that orders. That is a logistic services. And freight forwarding is like company F coordinates international shipment of company R. So it is arranging the shipments for the transportation from UAE to Saudi. And then for each arrangement of the shipment, per shipment, they are charging a fees for it. So that's a freight forwarding is a qualifying activity. So now when we have looked into those two distribution and logistics services, now what are the criteria to be met to be fulfilled as a free zone benefiting of qualifying activity? So now to be a qualifying free zone person, first is that you need to derive those qualifying income, which we mentioned that it should be either qualifying activity or should not be part of those excluded activities. So there are 13 qualifying activities, and there are 5 excluded activities. So it should not be, it should be part of the qualifying, to be eligible should be a qualifying activities or should not be a excluded activity. And then another is that I'm maintaining an adequate substance. Now the substance is something which would vary business to business depending upon the kind of nature of the business. So, and important is that whatever it is, that they should be doing that core income generating activity in a free zone. So when I say like a distribution activity for a third port shipment, so you are taking an order from UAE based out of a designated free zone for supplying it from Singapore to Saudi. So you might not need the staffs. Number of staffs would be maybe like 3 or 4, depending upon the volume of the business you are managing in, the transactions you are having in. That might suffice your number of people, like even 3 people or 4 people, and having a small set of office may be sufficient to carry out that activity. So that would depend upon the size and the volume of the business and the nature of the business which you are into. So that should be supported as an adequate substance for carrying out. And the most important is that core income generating activities, which is your distribution activity, is being carried out from that free zone. And also when we talk about those 13 qualifying activities in which distribution and logistic is there, or even headquarter services. So headquarter services of providing the central procurement services, or it could be HR account or HR services, IT services, any kind of services of support services should be like provided from your free zone. And that's a core income generating activity, should be from your free zone area, particular free zone area, and should have office setup, people sitting in that office, and there's a payroll for those employees should be in that, under that particular trade license to support that these people are there in that. And this should be throughout this period. Substance has to be met throughout the tax period. So I mean, it should not be that in mid of the year, like Jan to December is a cycle, and you have to met those adequate people or office setup and everything from beginning of the year. And of course, audited financial statement is required because you are going to benefit of a 0%. So the authority want to validate whether you are actually carrying out those activities or not, or just showing in the books. So those need to be audited. So audit become mandatory, and also complying with the arm's length principle, which Prakriti will talk about in detail. So this arm's length principle become critical, because if someone want to benefit of transferring their tax from to the low jurisdiction, that is, I mean, qualifying free zone is benefiting of 0%, to transfer that income to the qualifying free zone to benefit of a 0%. For that, arm's length will be documented. Not elected for regular tax regime of 9% to benefiting from the 0% rate. Then other is basically talks about that if you fail to meet any of the condition, like in 2024 you have not done the audit of the financials, then you are failing to meet the conditions of a qualifying free zone in 2024. So you don't get benefit of qualifying free zone in 2024 and next 4 years. So that means until 2028 you won't be again applying to get a benefit of qualifying free zone person. So you should be consistently meeting those conditions. I mean, maybe like you have not maintained your documentation as per the arm's length principle, and even for 1 or 2 transactions that might be questionable, then you might lose the of 0% qualifying free zone. Very critical and need to be maintained throughout the year. And then even you can outsource the activities to a related party or third party in a free zone. So when I'm saying there's a manufacturing activity which is carried out, this is a manufacturing activity is a qualifying activity, and instead of you yourself manufacturing it, you are giving it to third party to manufacture on job work basis. So that also is that also can be condition eligible for a qualifying free zone benefit, provided the third party is following all the conditions, and there is an adequate supervision by the person who's outsourcing this. So they should maintain a proper supervision that it is being they are meeting all the conditions and criteria for a qualifying free zone. So here an example of adequate substance, like when we talk about the distribution activity, suppose the for you are having an office set up in a DMCC area, DMCC free zone, and but you don't have a office in the designated free zone. You have only a warehouse in Zavza, but Zavza it doesn't have a trade license, anything there. So in that scenario, you having a warehouse in Zavza free zone, and your trade license is in a DMCC, your office setup, and the people are sitting in the DMCC area, then you won't qualify. You need to have that substance even in the Zavza free zone, that you have an office setup, if people are sitting there and there's a trade license in the Zavza free zone, benefiting for a qualifying activity in case of distribution. Now, suppose there is a free zone logistic company. So company P registered in a free zone, suppose in a DSO, a Dubai Silicon Oasis, with 20 people in the free zone for core income generating activity of logistics. That means they are taking order and dispatching it. Then but the Vitika, please can you be on mute? Then executing those orders outside the free zone. This could be a case of delivery of food, where the delivery boys are running across the city, and then but their office setup is in a Dubai Silicon Oasis. The order is booked there. The people are sitting and executing, invoicing happening at from the DSO. But most of the people, 480 people, suppose in this example, is moving around the city. But still they meet the substance because they are the core income generating activity of logistic order booking execution, is happening from that free zone. Then headquarter services, which is basically your central services of procurement or HR or IT support services, happening from a Dubai, so DMCC free zone for a multinational company, and who's supporting the MENA region. For the MENA region, they have their headquarter services carried out from the DMCC area, and all the senior management, the decision making, who are the decision maker staff sitting out of the DMCC, and with a number of adequate numbers supporting that services, will fulfill the requirement of substance. So the number of people or the space, it all depend upon the activity they are carrying out. And if it is justified, showing that the activity which is carried out is sufficient with the number of people and the space, that will prove your substance. It's critical to have that substance, which again I'm saying is depending upon the nature of services which you are performing. Again, the holding company, which is into only investment into shares, security market, so they don't need much people around. I mean, they're just the senior management people with a small setup of office, maybe in DMCC, and then with that small number of people sitting there, and the board directors sitting there who are involved into the decision making of investment, that itself will fulfill the substance requirement. And then coming to the overall summary in terms of what are those benefit of, this is basically as Prajakta was referring to earlier. For a qualifying free zone, it is 0% corporate tax on the qualifying income, and other than the non-qualifying income, 9%. So there is no slab. It would straight away, even if you are earning like 500,000. So you cannot benefit of 0% up to 375,000. On the 500,000, which is a non-qualifying income, you straight away pay 9%. But on the qualifying income perspective, you get a benefit of 0%. So income from another free zone person, that is being so on the other than the excluded activities, like there were 13 activities of distribution, manufacturing, processing, and there were certain excluded activities. If you are not doing that activities, and it is within the free zone person, like a DMCC free zone dealing with Dubai Silicon Oasis, but the person to whom the services is being rendered, the logistic services or anything which is done within the free zone, there should be the beneficial recipient. Now, say for example, if you are doing a consulting services, so the consulting services is not included in the list of qualifying activity, nor it is also excluded. So you can benefit of that even consulting services from DMCC, and if it is provided within the free zone person free zone person, but he should be ultimate beneficial recipient. That is something is critical to see. And sometimes people are started taking the mid beneficial recipient. Then income from qualifying activity, which can be from mainland Dubai entity, I mean from the your free zone to a Dubai or Sharjah or UAE as well to Singapore or any other country, like which I was mentioning about distribution activities, the qualifying activity. So you can do it to the UAE, I mean within the Dubai mainland, Sharjah mainland, or you can do it to Singapore also, Saudi. That benefits because of his being a qualifying activity. Then income from qualifying intellectual property benefits from a 0%. The qualifying intellectual properties are the one which have a copyright, patent, and are registered with government authorized authorities. Those are some of those qualifying intellectual property. They also get benefit of 0%. And anything other than that, like there is a condition of de minimis, where even if you are doing any kind of non-qualifying activity, but if it is within the particular threshold of 5%, so if you're saying suppose you have 2 million of revenue, out of that maybe up to 100,000 of revenue is coming from your other than qualifying activities, or the qualifying excluded, other than excluded activities, you benefit from that qualifying income. So if you are within 100,000 from a 2 million, then you still meet the requirement. So what will happen that for 1.9 you'll be taxed at 0%, and then if for non-qualifying you will be taxed at 9%. So here are the revenue from immovable property which are non-qualifying. Revenue from immovable property in case of commercial properties, you are which are for office rental purpose. If it is given to a non-free zone person, it will not it will be taxed at 9%. And any transaction with for a residential, hotel, service apartment in the free zone is a non-qualifying income. Or any revenue from your domestic permanent establishment, that is a branch, a free zone person having a branch in Sharjah or Dubai mainland, then that would be a non-qualifying income. So that will be taxed at 9%. And a foreign permanent establishment, that means you have a branch in Saudi, that would be a foreign permanent establishment, then that income will be a 9% taxability. But there is another exemptions which are there, which is under different law, we can benefit of it. Then income from intellectual property, but it is not a registered trademark or other authorities, that is not a qualifying intellectual property, then that would also be taxed at 9%. So this is the non-qualifying revenue, which is 5% de minimis requirement of 5% revenue, total revenue, or 5 million, whichever is lower. So which I was referring to 2 million if you have, out of which 100,000 is your revenue other than your qualifying activities. But under the de minimis rule, you are within the threshold, you can still be benefiting. And the calculation for this total revenue, as we were mentioning, to commercial properties or transaction with non-commercial properties, those are will not be considered in your total revenue definition to identify your de minimis requirement. Then if you become a qualifying free zone person, then some of the benefits which are given under the normal corporate tax regime will not be available. So you cannot form a tax group with your mainland entities, because mainland entities would be paying 9% tax, whereas the qualifying free zone person pays 0%. So you cannot form a tax group with them. So that benefit will not be available with single taxable person, and then intergroup companies can be netted off. That is something which you will not benefit when you are into two different taxable regime. Then your small business relief, which is available for 3 million, less than 3 million, you won't benefit of it because you are already having a 0%. So you won't be getting any benefit under small business relief. Then qualifying group benefit relief is something which you are transferring asset between the group entities which has 75% common stakeholding. Then that gain or loss is netted off when you're transferring within the group, but that benefit will not be available in case of qualifying free zone. And is arising because of sale of stakeholding, you won't be benefiting from that gain and losses arising it in case of qualifying free zone. And the tax loss relief, which is carry forward of losses, and which is in corporate tax is unlimited here, unlimited. and that will not be available because of 0% corporate.
One box file.
The case of a non-free zone person, if you are deriving this income from qualifying activity like a distribution or manufacturing, then 0%. And if you are deriving income from a non-qualifying activity, then it would be looked into the threshold of de minimis, which is 5% or 5 million, whichever is lower. Then for a free zone person deriving income from your non-excluded activity, it is 0%, or if it is excluded activity, then it will fall under the de minimis requirement. Then with respect to the source of income from your either from your branch office in the Dubai mainland or Sharjah mainland, which is a domestic free zone, or income from outside UAE, that would be taxable at 9%. And in case it is a property, if it is a commercial property, then if it is dealt with only free zone person, then it is 0%. But if it is a non-free zone person, then it is taxable at 9%. And for residential properties, those are 9%. And then so first you need to identify those activities which you are dealing. Is it fall into the qualifying activity, or it is part of excluded activities? And then once you identify that you are into that businesses of qualifying activity or other than the excluded activity, then you can think of looking around benefiting of the free zone, that whether you meet the substance requirement in terms, and then you are doing this documentation of arm's length, and those principles need to be followed. And then you see whom you are dealing with. You're dealing with a free zone person or non-free zone person, then you know that which is a qualifying income and which is not a qualifying income, and accordingly you derive your tax. So these are the stages you need to analyze overall. So now I hand over to Prakati to take over with respect to the transfer pricing. So I'll stop sharing, and Prakati, you can start sharing it.
Thank you so much, Manish, for this insight. And let me take you through the aspects of transfer pricing to the UAE corporate taxation. So let's first understand am I audible?
Yeah,
Okay.
you're audible.
All right. So let's first understand, just a moment. Yeah. Let's first understand what the requirement for transfer pricing, why transfer pricing is there in the UAE while the corporate tax is there. So if you see this example, there is a company A, which is say in UAE. It sells its goods to group entities as well as to other third parties. Now, group entities are somewhere which are related by ownership or control, which we will see later on. So this company A, if it sells a product to company B at say 20 dirhams, and at the same time, it also sells this product to company C at 10 dirhams, you see a price difference. But does that impact, and how does? Let's see that. So when it is a related party and you sell it at 10 dirhams, you are selling at a lower price and hence recognizing lower profits in your jurisdiction for say company A. And while you are selling it to a third party, company B, then you are selling at a market price. So broadly speaking, when the transactions are with the unrelated party, they are ideally driven by the forces of market, and there is a lot of business negotiation that happens while the price has been set. However, when we talk about related party transactions, the prices are generally or ideally they are tainted or influenced because of the relationship between the two entities. So the law says that the transactions between two related parties should be at arm's length. And if not, there are high chances that companies in low tax jurisdiction would want to have more revenue or profits booked in their jurisdiction so as to eradicate or eliminate the overall tax outflow in their global income. So now the transfer pricing guidance talks about various methods and to determine the arm's length pricing, which is also known as the market value of a transaction. So on the basis of the functional analysis, you decide what kind of method suits best for the transaction in hand. When we say comparable and controlled price method, these are specifically transactional method where product to product comparison is made. Whereas as we go broad, there are methods like cost plus method or transactional net margin method, which takes care of the function for the purpose of comparability of pricing of transactions with a related party vis-a-vis third-party transactions, so as to say that the transactions are at arm's length. So we spoken about the transactions with related parties have to be at arm's length. Now let's understand that what are these related parties? The law has defined in Article 35 a relationship based on kinship, ownership, control, as well as connected persons to define a related party. So by kinship, it refers to a relationship between natural persons or individuals. And the definitions takes you to the fourth degree of kinship to establish a relationship. Now, it also includes relationship as a result of affiliation, that means relationship with the spouse, and also covers any relationship which is occurring by way of or the guardianship. So the scope of relationship arising out of kinship is very broad. And even if you think that broadly the families are different, but if they take you to your fourth degree of ancestors and descendants, then also they are covered in this definition of related party for the purpose of UAE corporate law. Moving ahead with the ownership criteria. So any relationship arising out of ownership interest, that means interest in terms of equity or any other ownership, which is more than or equal to 50%, gives rise to related party relationship by way of ownership. A simple example could be a relationship between holding and a subsidiary company where the ownership interests are, say, 100%. It also talks about indirect ownership interest. And by that, we mean that if an ultimate parent company holds shares in its subsidiary, and this subsidiary holds shares in its fellow subsidiaries, then also the ultimate parent entity as well as the step-down subsidiaries are also related parties. The other important aspect is how to see this relationship of ownership. So the scope is again broadened to say that if the ownership is done directly on its own, say the ultimate parent alone owns certain ownership criteria, which is more than 50%, or it together holds this ownership, which is more than 50%. So one aspect is direct and indirect ownership. The other aspect is whether you hold it on your own or together with your related party. All this covers in the scope of related party relationship. The third and very broad criteria to define in the related party is the control mechanism. So control is referred to as any influence or direction or significant influence, control exercised by a person in a taxable person. Now, it may arise because of ownership or because of the voting rights or sharing of profits or having a capability to determine the composition of board of directors or any other relationship which translates into a significant influence that controls the decision making of the business is covered in this. An appropriate documentation and identification of this control is very important, so to say that transaction arising out of control is or is not in the net of related party relationship. The last aspect of related party relationship is the connected persons. So any relationship arising with a taxable person and a natural person as a result of ownership interests or control or any significant influence or as a key decision maker, being a director or officer in the taxable person also gives rise to connected persons. Now, the law has also said that any payments to connected persons are deductible for the purpose of computation of tax only to the extent that they are at arm's length. So, if a company is making payment to its directors or officers or chief technology officers or the head of core business, who are the decision makers, who are the influencers of the business, are to be characterized as connected persons, and the companies need to check on the payments that are made to them. Because if it is identified later on by the tax office that these payments are more than what a market value would, a prevailing market value would have done for these payments, then the balance payments would be not allowed as deductions and would be disallowed, and there would be tax consequences on such amounts. So, identifying who is the related party, what are the transactions with them becomes very critical from the perspective of transfer pricing compliance, but as well as from the perspective of the overall tax liability. So, what are the related party transactions? Let's start with an example where we will take you through how a related party relationship arises and how a transaction may influence or trigger whether it should be at arm's length or not. So here's Mr. Ali, who owns company A, and there is his wife, Mrs. Ali, who controls company B. So broadly speaking, company A and Mr. Ali are related party because of ownership, and Mrs. Ali and company B are also related parties as a result of control, which is part of the related party relationship. However, what would happen if there is a transaction between company A and company B? General perspective would be to say that company A and company B does not have any relationship. But if you go deep into the definition, as we saw earlier, if husband and wife who are related through kinship, because they are together hold some kind of control on ownership in each of these entities, any related party transaction between the underlying companies A and B would also be called a related party relationship. And the next step is to see that the transaction with related party, that is between company A and company B, are at arm's length or not. Now, when we say arm's length, there is a whole lot of exercise that is required to be done. But now first, since we have identified what is related party, let's take you through the various kind of transactions that may arise as a result of this relationship. First would be transaction of purchase and sale of goods. There might be a distributor who's buying and selling of goods. There might be a manufacturer who's manufacturing and selling these goods. But if these goods are bought and sold with the related party, it is called as a related party transaction. Similarly, in case of services, for example, management or headquarter charge or administrative services, for example, IT services, HR services, there could be a host of services transaction as well. If entered into between two related parties, can be termed as a related party relationship. Other transactions in this row are financing arrangement that includes intra-group loans or guarantees given by one entity to other for taking a loan from bank. A transaction of purchase and sale or transfer of a tangible property or an intangible property also gives rise to a related party relationship. Then there are items of expenses which are incurred by one entity on behalf of its related party, and which is a very common scenario across the globe. It might happen because of the administrative convenience or because of the obtaining the economies of scale or benefiting from the synergy. These costs are also required to be recharged and be required allocated to the beneficiary entities. We will take you through this in detail in later slides. So as Manish spoke about the third port shipment in earlier section of qualified free zone person, I would like to take you on the transfer pricing implication of the same. Say, third port shipment is very common phenomenon in UAE jurisdiction because of the dynamic location of this country. You can call a third party shipment by various names. Sorry, third port shipment. You may call it as a drop shipment or foreign to foreign shipment, or also call as high sea sales. So basically what happens is that goods transfer from one location to other. However, the billing is done from a third jurisdiction. So let's take this example. On the left, there is country A, which has a manufacturer company A. And then there is a company C, which is in the designated zone in the UAE. So now this company C in the UAE has got an order from company B, say in Saudi Arabia, to sell some goods. So this company C is generally a distributor. It does not have its own goods, though a distributor, but it will have to deal with its manufacturer, who is again a group entity based in country A, for selling it to its customer in country B. In a third port shipment scenario, the goods, as you see in the dotted lines above, that the movement of goods takes place from country A to country B. And it is important to note that goods do not enter the zone of UAE. It travels directly from the manufacturer to the customer. Now then, what is the role of UAE? Is that it is the entity who is the distributor, who will make an invoice because it is its customer. Company B is its customer. So the invoicing will happen between company C and company B. However, the goods would travel from company A to company B. So let's understand whether it's a related party relationship and if it is within which two entities. So it's clear that country B is a customer and it's a third party. However, company A and company C are related parties. A being the manufacturer and C being a distributor. So what would be the transaction? The transaction would be purchase of goods by company C from company A. Again, although the goods are moving beyond the borders of UAE, but it will still be recorded as purchase of goods between A and C. So, since it's related party transaction, there is a need to determine arm's length price in this case. And how we do it is a two-step process. The first is to undertake a detailed functional analysis of the transacting entities. So one has to see that what are the roles, responsibilities, functions, assets, risks that are undertaken by a manufacturer company A to this transaction, vis-a-vis the same for company C. And once it's identified which one is the low risk entity which is performing lesser functions comparatively to the other related party, in that case, that entity is taken as a tested party and a comparability analysis is performed on the tested party itself. And a tested party is specifically not, it's not fixed that it will be a manufacturer or a distributor, and it totally depends on the facts of each case. If by the functional analysis, it is identified that the manufacturer sitting in country A is the tested party, and it is the one who is having lesser functions and lesser risk, then in that case, it may be characterized as a contract manufacturer, depending on the facts of the case. As a contract manufacturer, the ideal remuneration could be cost plus arm's length markup on the operating costs. Mr. Paul, may I request you to please put your mic on mute? So now what happens that in a contract manufacturer scenario, the markup is charged on the costs incurred by the manufacturer as a contract manufacturer for performing its business. On the other hand, if from functional analysis, it is identified that the distributor who's sitting in UAE is a low risk distributor, again, this means that it is having lesser functions and lesser risks in relation to the overall transaction in the value chain, then this low risk distributor's arm's length price would be determined. So in a distribution scenario, generally the markup is charged on the amount of sales, because that is the transaction which is the affecting transaction, which is the key parameter to analyze what a distributor should have. So in case a manufacturer is a tested party, it will retain its share of arm's length markup in the overall value chain, and the balance residual profit would reside with the other entity, which is probably the entrepreneur or full-fledged distributor. On the other hand, if it is a low risk distributor, then the low risk distributor would have its share of profits as arm's length markup, and the balance share of overall profitability would go to the transacting party. Now taking over the logistics services. This is a classic example where a logistics service provider may be directly owning fleet, ships, or aircrafts, is providing services, or maybe it is providing services using the assets of a third party. So now a logistics service provider would ideally be providing services such as transportation of goods from one place to another for its customer. It might also be providing warehousing services for storage of goods, or management of inventory for the time that the customer has not taken it. It also includes freight forwarding services, order fulfillment, and packaging and repackaging services at hand. Now, in this example, company A is a logistics service provider, and it is providing services to a lot of entities. However, if we group, it provides these services to company B, who is a manufacturer, and also to company C, which is a third party. So primarily, it is a service provider in the logistics industry, and it may provide within the group entity, which is a related party, or to third-party customers. However, it's important again that the transaction which company A would have with company B has to be at arm's length. Now, there is a scenario where an internal comparability can be undertaken and the operating profitability or operating margins between transactions with A and B vis-a-vis transactions between A and C are compared with the operating margin profitability to identify whether the transactions with related party, that is company B, are at arm's length or not. And ideally speaking, the transactions with the related party has to be at a margin which is higher than transactions, higher or equal to the transactions with a third party. Then only it will be said that the related party transactions are at arm's length. If at all, the comparability in the internal books or internal comparability is not feasible because of the factual reasons, then an external comparability can also be undertaken, whereby a benchmark can be conducted on an external database, whereby the operating margins of companies available in the pool of database, which are also engaged in logistics service provider with the same function of operations, would be identified, and a range of the margins that they are earning would be calculated to see that whether a transaction between A and B are at arm's length vis-a-vis those transactions which are undertaken outside between the third parties. This is a very detailed exercise that is to be undertaken on an external database, and but it gives you results so that the tax office would be, you have sufficient documentation to say that your transactions with the related party were at arm's length. So whether it is internal comparability, if the facts allow you to compare your transactions with the related party vis-a-vis third parties, or whether it is external comparability, where you compare your transactions between related parties with third-party transactions, not where you are not a party, but between two third parties. But any of these scenarios is possible, but a thorough documentation of it is important in case there are any related party transactions. We would also like to take you through intra-group services, which are very prominent and in the UAE region as well as across the globe. So we have divided these intra-group services into three parts. Before we move forward, let's understand what are intra-group services. So as the name suggests, a multinational group which has existence in more than one entity, or for the purpose of UAE, where even the domestic transactions with the related party are also required to be at meeting the transfer pricing policies. In that case, if within the group, the services are provided by one entity to the other, they are called intra-group services. Let's first understand the pass-through costs. So as the name suggests, pass-through costs refer to costs that are incurred by one entity and passed to the other. A classic example of a pass-through cost would be cost incurred by company A for availing marketing agency services of a third party. However, company A is not the only beneficiary of the services, or maybe only for the purpose of administrative convenience, company A has made the payment to this marketing agency, but the actual benefit of the services were availed by company B, which is again related to company A. In that case, if the expenses are directly identifiable, the recharge should be made by company B to company A. So initially company A has made payment to a third party, which has benefited its group entity. So this other group entity should make payment to company A to say that this is the payment for the services that I have actually benefited from. So pass-through cost can also be called as reimbursement of cost, and it is undertaken for facilitating the administrative convenience for the payment. It's important to note that there should not be any element of service, which we will take you now, later on, in the pass-through costs. In case of a low value-added services, ideally it's a cost center that is providing services to its group entity. So you would have seen a common scenario that there is an entity where the accounting or human resource or the IT support team or maybe any other support team is hired, and these services are being availed by various entities in the group. The low value added services says that the services should be in the nature of supportive nature. Should not use a unique or valuable intangible. It should also not create a unique or valuable intangible while the services are being provided. At the same time, there is no substantial risk involved in providing the services. So when a company which is engaged in manufacturing of, say, valves, an accounting or an HR service would not be a core business activity for it. So you can say that this is a low value added services. Vis-a-vis a core business activity is something that one entity in the group might be providing to other entities which are forming the core business activity. It involves use of unique or valuable intangible or may create such intangibles. And at the same time, risks are involved in providing the services. A classic example of core business activities would be a IT company, which is providing technology services to its other group entities. In that case, it is termed as a core business activity where the benefit of the main business activity has been availed by other entities in the group. At the same time, any activity in the nature of headquarter services, which require a management charge, where the core business team is situated and they are taking the strategic and the business decision for the whole group, those kind of services are also called as core business activities, because that is not anything which is supportive in nature, but helps the business grow in its core. For each of the activities, we need to understand what are the costs that are required to be charged from the group entities and whether a markup is required or not. So for pass-through cost, as we discussed, it's just a reimbursement. So there is ideally not required to be charged any markup on that. However, a cost-to-cost reimbursement on a timely manner is very much required in case of a pass-through cost. While we speak about low value-added services, the OECD guidance specifically talks that if the criteria of a low value-added services are met, in that case, a 5% markup, a minimum of 5% markup would be sufficient enough to say that the transaction is at arm's length. Now, in case of a core business activity, because it's not of a supportive nature, a detailed functional analysis, which includes function, assets, and risks, is required to be carried out, which tells you what are the activities and what are the responsibilities undertaken by the transacting entities. And once this is done, a benchmark is required to be conducted again on a database to say or arrive at a markup. So in a scenario where UAE did not have corporate tax or transfer pricing previously, there are certain services which were provided by one entity to other without a markup as well. However, it's the right time to undertake a transfer pricing policy, plan the transaction, understand the transaction, identify a pricing mechanism through a step-by-step methodology, which is very much there for transfer pricing. So to say that the price at which a company would be conducting their transaction is at arm's length, and the exposure from later on TP audits would be less. So this intra-group services may have a scenario that one entity provides services to multiple entities in the group. In that case, it becomes a question to the clients to say that what should be the basis which I should charge the cost from each of these entities. A basic thing would be, should I charge equal? But that would not be logical or rational. Then there is a guidance again by OECD, which gives you two methodology, a direct and an indirect charge. Direct charge method, as the name suggests, is something where the charge is directly identifiable. If a marketing agency charge of third party is available, then if it is clearly available in the invoice or an agreement that this is directly identifiable, then you can charge directly, and this would be the best method. However, in most of the cases, the cost would be fall into indirect charge method where a cost allocation would be required. And as you can see in the red box to the right of this slide, allocation could be done on various aspects. Or, for example, allocation on revenue, or maybe headcount of people, or maybe of the total operating expenses. Or for example, if it is allocation of rent, it could be done on a square footage basis. It totally depends on the facts of the case, and OECD has provided guidance. So once it is available on record that what are the nature of services, what is the drivers that will help you identify the allocation mechanism, a ratio can be identified. So now when we speak, there is a lot of terminology and jargons that we have spoken about. So it is very much important that a robust documentation is prepared, which covers the transacting entities, which you may call a related party. What is the relevant article in the law which gives rise to this related party relationship? What are the transactions entered with the related parties? What are the beneficiary of the goods or services, as the case may be? If there is a cost, whether it is directly identifiable or no, it requires an allocation. What would be the allocation mechanism? The allocation again has to be done on a very logical and rational basis. And where will you put all these things is a TP documentation, where all these facts and analysis and benchmark and again supporting evidences would be kept on record on a contemporaneous basis as and when the transaction is happening or by end of the year. So to say that every transaction with the related party was at arm's length. At the same time, it is important that the FTA has provided a revenue threshold whereby any company which earns more than 200 million in a year as revenue is required to prepare a TP documentation, which includes a master file and a local file. Or if it has to be seen from a perspective of a multinational entity, the threshold required prescribed is 3.15 billion dirhams. So if you fall in this threshold, you have to compulsorily prepare a TP documentation. However, even if you fall below this threshold, it is important that whatever is the supporting evidence that you are forming basis for the purpose of arm's length determination are captured properly in a documentation. So this is it from the perspective of transfer pricing, and maybe I'll hand over to Manish for the remaining.
Yeah. Thank you, Pragati, for taking us through the understanding the related party, connected party definition, because that's much important to know. Are those connections there in the business? And then we identify those transactions which Pragati identified with respect to intergroup services or any kind of businesses which we are doing with them. And then that's an arm's length requirement for that. So now, I mean, just quickly brushing up on the city administration side of it. So on the city administration, what we look at is that in terms of the return requirement, it is one annual return, whereas VAT, we have quarterly return. So in the corporate tax, we have one annual return, which is being filed 9 months after the end of the financial period, as we assume that most of the companies in UAE would have Jan to December as their financial period. So the 9 months thereafter is the September 2025 being the first tax period, the return to be filed. And it will be filed electronically through the MR portal and the FTA website. But I think the more important is that though there's a 9-month time to file that return, but by the time we are closing the year, there are certain adjustments which we need to be done, in terms of allowability, disallowability expenditure, or with respect to the arm's length transactions which you have within the entities, the transactions which are happening in the entity that which require arm's length documentation, or benchmarking, or a common cost allocation of intergroup services within the entities. So those need to be done now. I mean, as the end of the year, we are approaching towards the last quarter of the year. So those need to be carried out in your financials, the allocation, the cost allocation basis, the direct and indirect basis that need to be looked into it, or even the payment to the connected parties, whatever payment is being done in terms of the salaries and things, those need to be adjusted. So someone has to look into those aspects before they close this year of 2024. And then these are the way it's carried out to determine your tax liability, which we presented in earlier webinar. It starts with your accounting profit, and then you do adjustments of like exempt income, deductible, non-deductible expenditures, and adjustments with respect to your realized, unrealized gain losses, intragroup services, and then you derive taxable income, and then you do the adjustments of any withholding tax being paid or any foreign tax credit with respect to operations outside UAE where you have already paid a tax there, and then you can make an adjustment for that, or any kind of business restructuring, release, any kind of stake sale is happening, any gain relies on that, then you get a benefit of under the business restructuring relief, or any kind of tax losses be carried forward from the future period. I mean, this is for the past period. So tax losses, I mean, this can be only deductible from the year when if the tax is applicable. So it is applicable most of the entities from 1st January 2024. So any tax losses, any losses in the business are the one which is from this 2024 onwards, not for the prior period. Or, I mean, this can be carried forward unlimited years, and there's a limitation of 75% of your taxable income, I mean, the accounting income, to which you can make a relief of it. So that's how you calculate your taxable balance tax payable. And then, this overall, now what you need to be ready to look at the structure which you have. You need to assess your structure to see whether you are meeting the requirement of the free zone, having the educated substance in terms of, and if you have a group, whether to form a group tax registration, because under the VAT, the grouping is separate, and under the corporate tax, the structure for tax grouping is separate, and we need to analyze the benefit of it, whether to form a tax group or not, and need to assess the related party transactions, understanding those connections between the related party or group companies, having an arm's length documentation for those transactions and identifying any exempt income or changes which might be required in your chart of accounts because of certain items deductible or non-deductible that need to be adjusted in the financials, and also look around any kind of income which you have from outside UAE, because that you will be taking a tax credit. And also in terms of any place, I mean, there could be also non-resident having a PE in UAE, so that taxability need to be looked into it. And a OEM place of effective management control from UAE for any business outside UAE. So those tax implications need to be assessed. And of course, people who are into the finance team or the accounts team, they are the ones who's going to work around this. So they need to be aware and they should be getting trained on this. Yeah, so that's the area basically everyone need to analyze from the perspective. So today we spoke about primarily on the logistic and the distribution activity being part of the qualifying activity. So there are 13 qualifying activities. Some of them are on the goods, some of them are the services, and then there are excluded activities. So, and for a distribution being a qualifying activity, it has to be carried out from a designated free zone. That's important. In and out from a designated free zone is important. And for a logistic service, it can be carried out from any free zone. But of course, the certain conditions of substance is the most requirement to be met. So yeah, that's basically what we have today to present about it. And then of course, how we can help our client, and we have been helping them to assess their financials, to look at the structure they currently have it, and identifying those transactions from the perspective of related or connected party, and how the cost allocation has to be done if there is a group company and there are intergroup services being done, and then the arm's length benchmarking for that, and of course we do assess on the tax assessment from the what will be a tax liability considering this 23, which is a financial period where you have a financials done, so that we can do a mock assessment of what will be tax liability, and also see how we can plan your financials to structure well in terms of compliances from the regulatory framework. So yeah, the SNB team is there to help you out on any other structuring or assessment you can. And now, anyone who have any questions about what we spoke today, we are more than happy to address any of your concerns or any point you have to discuss on any of the topics we presented today. Anyone want to discuss about any point? So I think the Prakati today talk about intra-group services, and I think that's that would be the common aspect which we can see in UAE, where there are multiple companies or group companies having common support in terms of finance, IT, marketing. Those how that has to be allocated. But maybe you can just rephases on that the allocation that is required, for the common cost among the group companies, and in terms of benchmarking is required on that. So yeah, Prakati, if you want to re-emphasize on that point with respect to the common cost allocations.
So yeah, see what happens in the common cost scenario is that there is always business happening in a multinational entity group where there are more than one entities in a certain group. So expenses which are incurred by one entity, which might benefit the other, maybe it has the element of services. That has to be evaluated in detail to understand what is the recharge that has to be done from the beneficiary entity of those services, or whether it's just a reimbursement or pass-through costs. At the same time, if it is a service, it's important to analyze that whether these services are low value added cost, which just require at least a 5% markup over the cost of services, or in case if it's a core business services which are provided, whether it requires a separate benchmark to be undertaken to say that it's the transaction are at arm's length. So it is important to, check your financials and see what are the related party transactions, what are the services that are being provided in the group, within the group, and then to say that whether they meet the arm's length standard or not.
Yeah, yeah. Thank you, Prakati. So we would be sharing this, recording of the today's webinar. So who has not yet shared their email ID, maybe you can drop down in the chat box an email ID, and we will be sharing this recording for your future reference to, again, watch it for a better understanding. And you can also reach out, in terms of for any further queries specific to your business, and we can be of help to guide you through that. So, anyone who is interested to have this recording, you can share your email ID and we will share you this link of our recordings today. So any questions anyone want to have, any point to be discussed or clarified, we can talk about it. Okay, great. So I think we are done for today, and we will keep you posted for our next webinar, what we present. So thank you all for being today in the webinar, and you can get back to us. I mean, we have on our site our email IDs and our contact number. You can log into our website snbconsulting.ae. We have our contact details on that, and we can be more than happy to help you or understand your queries.
Thank you so much for being with us and listening through the session. Thank you for your time.
Thank you. Bye.